Let me now bring on board a special guest, Dhaval Mehta, Head of India Equity Investments with Reliance Asset Management, who joins us from Singapore. Of course, Dhaval is a old India hand. He's got over 20 years of 20 years of experience when it comes to managing public money. Dhaval, this is your first time on ET Now, so a very warm welcome and thank you for joining us. Dhaval, how would you sketch the big picture for us? Because it's been a week of scary fall and high volatility.
Yes, indeed. I mean, the last few weeks have been fairly volatile, and it's largely been on one side. And so, we've gone through a fair amount of short-term turbulence, given what's been happening, on the currency and in the bond market as well as in the equity market. So I would think that yes, it's been a fairly rough ride over the last few weeks. And, we are just hoping that things will settle down and, we'll get back to some kind of normalcy in these markets.
Dhaval, whereas rupee has corrected, bond yields have appreciated to about 9%. Some would argue that the index has not corrected. We are only 20% away from an all-time high, and at least benchmark indices are not really capturing the true pain trade.
Yes, that's a fair point, Nikunj, but if you look at the Nifty or if you look at the Sensex, you will find that there are a few stocks out there that have done exceptionally well. And these have very large weights in those benchmarks. And so to that extent, they have kind of protected the Nifty and the Sensex from falling too much. But these are, a handful of stocks. Probably you can count them on the, on your two hands. I mean, so in that sense, the market performance has been fairly lopsided. If you strip out these stocks that have done well, you'll find that the rest of the Nifty and the broad market actually is a lot lower than what the Nifty level would have you believe. So in that sense, Nikunj, I would think that I know that the market seems to have fallen just 20% or 15% from its all-time peak, but the broad market and the Nifty X these stocks has actually taken a much bigger beating.
Dhaval, hi, morning. So what's the prudent investment strategy in this kind of a backdrop? I mean, would it still make sense to hide into places like defensives as well as IT stocks?
Sure, absolutely. I mean, it's you're very right. It's been very tough, from a portfolio perspective, because how much can you really buy into the names that you mentioned? So in that sense, I guess at some stage you will have to be a little brave and start looking at stocks, high quality stocks that have gotten unduly hammered. So I guess it will get down to some serious, bottom up analysis. You will have to go out there and look for stocks that are holding up quite well in terms of their earnings performance, and try and see how you can take advantage of that. So the sense is that yes, most people are hiding in tech and in pharma and the kind of stocks that we know. But at some stage, given what's happened to the rest of the market, one will have to take a call, of course, selectively, and see whether you can get into some of the other names as well.
Dhaval, I also want to understand the general investing mood from you. You pretty much have the pulse of global investors. Are you now getting a sense that global appetite for Indian equities is diminishing? 2006, 2008, India, China were the most sought after destinations. But now that interest is clearly waning on the downside?
Sure, absolutely. I mean, I think I would tend to agree with that, Nikunj. Obviously, given the way the currency has performed, and I would just like to highlight that as the one big factor that has, impacted sentiment, because, my own experience of interacting with foreign investors has been that the rupee's performance tends to overshadow, everything else. So in that sense, I would agree that the news flow and the news out of India hasn't been particularly encouraging. And to that extent, obviously the mood of the foreigners and of investors in general has soured. This is not, given that, we saw very strong inflows for the first, 6 months of the year. And to that extent, it's been a disappointment. Having said that, I'm sure there are people out there who probably know the market well or the economy well, and are probably thinking that that this is probably overdone and it's now a good time to actually have a fresh look at India. So I would think it's a bit of a double-edged sword. Yes, the performance of the market over the last 2 months has been disappointing, but that just might mean that it's an opportunity for people who are looking to get into the market.
Dhaval, fair point. That's one side of the story. But the other side of the argument is that, look, India is a crowded trade. India is an overowned market by global investors. And at a time when money is moving out of emerging markets, a overowned market like India could really suffer the most.
Again, I would agree with that, Nikunj, because India has got a disproportionately higher share of foreign money this year as well. I mean, if you look at the year-to-date numbers. So in that sense, yes, India, a lot of investors over the last couple of years have gone from being an underweight position to probably neutral or even overweight. So in that sense, I would agree with you that it's a bit of a crowded trade, and given how critically dependent the market performance is on FII flows, that is a bit of worry. I mean, if there is an outflow from emerging markets, and if there is, and therefore if India continues to see outflows, then that's obviously bad news, for market performance. So in that sense, the global, issues in terms of what happens to emerging markets in general. Do you see, money going back, from emerging markets into developed markets, which is what we've been seeing over the last few weeks. If that trend continues, then it's going to be very, very challenging.
Dhaval, you have a large exposure to pharma as well. What makes you so bullish on this space? The weakness in the currency or the business environment per se?
No, it's largely been a call on the business because, currency is something that, we can't really kind of predict. I mean, there was no, way of knowing that the currency would behave the way it has. So we've never really taken a very simplistic call on this that, okay, let's just, we think that the rupee is going to be weak, so let's buy all the exporters. It has never been a call like that. We've actually, you are right, we do have a large exposure to pharma, but that's largely driven by our conviction on the names that we have in the portfolio. We do like the business at a macro level. We believe that this business is something that can continue to give fairly attractive, growth, driven by both the domestic market as well as the fact that a lot of Indian companies now have very large markets in other geographies. So we like the sector in general, but the idea, again, the portfolio is essentially driven by our own bottom-up work on some of the names, and yes, it has done. The pharma has really helped us in these times, wherein it has kind of been a lot more resilient than the rest of the market. And, that has helped our performance. But really, it's not really a macro call that we are buying pharma or IT because of the rupee. And so, it's actually, again, a very bottom-up process that's helped us in these times.
Dhaval, what is your take on industrial stocks, especially quality capital goods stocks? They are beaten down, valuations are nearing historic lows. Are you of the opinion that there is a big trade there, and whenever economy recovers, these stocks could be the first one to bounce back? Are you aligning your portfolio for this comeback trade?
Absolutely. I mean, at all points of time, we are, looking at the entire spectrum of sectors. I know it's been a hated sector, and for the right reasons. We've seen the investment cycle, go completely, dead over the last, couple of years. So it's been a very, very difficult time for most companies in that sector, and as you rightly said, that entire sector is completely bombed out. So it is something that we are, watching all the time. We want to make sure that we do our bottom-up work on some of the names out there. And again, as and when the cycle turns, you will see obviously a large, return come from some of those names. So in that sense, while we currently don't have any exposure to that space by and large, it doesn't mean that we are not focusing on the sector at all. We want to make sure that we do our homework and we kind of do our work on some of the names in those sectors, so that as and when the tide turns, we are there in terms of where we want to be. So I know it's a sector that has been completely out of favor over the last 2 months, but I wouldn't want to ignore it completely, even at this stage.
Naval, good chatting with you. Really appreciate you taking the time out and speaking with us.